Hello, everyone. Welcome to the stock-specific class here for Thursday, March the 4th. I've had to kind of scramble a little bit because the outlook that I was going to talk about originally shifted dramatically in the last hour as Chairman Powell came out and talked about how if the economy, if we start to get back on track from COVID, that we could start to see inflation pretty quick. He said temporarily, but that really spooked the market, and it's been selling off ever since. So it looked like we were having a little bit of a bullish reversal day until that point. So I think that's really what fueled the selling too, is when people started to bought the dip a little bit, and then things reverse like that, and they really start selling off. There was a little bit of a panic. So I did come up with a list of specific stocks to get into, and I had probably more than I would have normally. I wouldn't have had this many if the market was selling off like this. So we'll look at those charts, but we might want to keep that in mind that well, we're looking for a confirmation anyway. We're waiting for it to go back to the buy signal anyway, so that shouldn't be a problem with these that we're looking at. But I probably wouldn't have been going over so many of them if we were in a free fall like this. But like I said earlier, we had look like a really strong bullish reversal day, and so I had a little bit bigger list set up there. By the way, at the training today, we're going to continue talking about options. If you didn't go through the training on Tuesday, there's a lot of definitions and explanations of how options work that we went through. You might want to go and review that. We're going to continue with more definitions and explanations. We're going to talk about what calls are, what puts are, what a strike price is, and expiration dates, and the bid-ask spread. Although if you've traded stocks before, you should already understand the bid-ask spread a little bit, but we'll talk a little bit about that as well. Well, I'm hoping we get that far. We'll see if we can get that far before we run out of time. Let's quickly go through not much has changed on the direction alerts. We're still in kind of that tired market state, where you've got sentiment above momentum, which is above breadth. And so it's not surprising that the market is selling off a little bit. When you can see that happen a lot of times when it's in a little bit of a tired condition there. The other alerts they're not in any overbought state. They're kind of right in the middle, and so not much to really add to that. And same with the buy-sell ratios and the sentiment. We'll skip that right now just because nothing's really changed from Tuesday as far as that's concerned. We're not seeing an overbought condition. In fact, just the opposite. We'd be looking for a little bit more of an oversold condition here pretty soon. But I do want to get to the charts. And what was key to me, it has been key to me, is that QQQ chart. I've talked about this a number of times in the last couple of updates, that I felt like this trend was broken and that we had further to drop. A key area that I was looking at, though, was as the support area was back here, this September high right back in here. I'm on the one-year chart, so we can see this. This is a major reversal, so that tends to be a support area when it comes back down, and this is not going to be it's a very straight line. It's not the straightest line because we were right at it, and we were starting to rally off of it earlier today, and then since then we've broken through and we're below it. And so that's worrisome because the next support area is down here. I mean, it's down around 270 or below 270 on the QQQ. Now, the reason why I think we could see further downside as well is if we look at the SPY chart, and we can stay on the 6-month chart for this one. I think we can see that support area. Now, let me go to the 1-year chart to make sure. Well, there's a couple here that we could be looking at. that September high is pretty far away. So let's go back to the 6-month chart. The more recent low that I'd be looking at, why is this not updating? This is something, I don't know why this is not updating the chart, because we're down. Maybe it's just, I don't know how much delayed the chart is, but we're down quite a bit right now. But the next support area that we'd be looking at is right here. And that's at about, 368, somewhere in that area there. And so there's quite a bit downside. But now if we're starting to see some of the other indexes kind of starting to break down a little bit, and the Dow chart showing the selling here, so it's starting to sell off quite a bit. But you'd also be looking at that same low here on the Dow, right down here. That previous low is a target for support. You're hoping it holds a support right there. Now, this is good, though. This is good that we're getting to selling. What I've talked about the last few updates is that you got to get a kind of a flush out selling that takes place in order to get these really strong rallies. If you only get a little pullback, then even if the market goes higher, it tends to be sluggish and more sideways or choppy, and it just doesn't move very fast. And so you like to see a bigger pullback that can allow for these stronger uptrends. I go back to, if you go back here, you can see we had this big sell-off in October, and that's why we had this nice sharp rally in November. Here we had, just kind of a little pullback right here. And so when we broke out higher, it kind of just stagnated. And each of these times we didn't really pull back. We just kind of moved sideways. So every time we broke out, it was just kind of still consolidating. It didn't have a deep enough pullback. Here we got a little bit of a deeper pullback, and that led to this sharper rally right there. So to get these deeper pullbacks, it allows for you to get these bigger runs on these upward moves. So it's good that we're kind of selling off. Obviously, if you had a whole bunch of stock positions, you're probably getting beat up, and it may not feel that great right now. But if you listen to me for the last 3 or 4 updates, I've been warning that you might want to be, the market was looking like it was going to sell off, and you might want to be taking some defensive moves, either tightening up stops, taking profits, or buying protected puts, which we're learning about options, so you can learn how you can protect your stock positions with put options as well. All right, so that's kind of the target areas that we're looking for as far as it pulling back to, and I'm trying to just kind of. It looks like we've rebounded a little bit, not much. But I have to kind of keep an eye on the market because, like I said, this has been selling off very, very, very quickly. And who knows, we could be down 1,000 points before I'm done with the update if the market is still kind of freaking out over this. Another thing to keep an eye on is the VIX. The VIX is starting to spike today, and it's indicating that fear. Now, sometimes when you get a really big down day and a big spike after we've already been moving down, it can sometimes be a little bit of a capitulation move, which means we might be at least near a near-term bottom here, where we get a little bit of a bounce or a rally off of that. Now, I was thinking that same thing earlier today. We had sold off a little bit, and I was expecting a little bit of a bigger gap down this morning. I was hoping for a bigger gap down this morning, because that's usually a good reversal sign. We've already been dropping, get a big gap down, that kind of capitulates the fear, and then it rallies off of that. But we just had a little gap down this morning, and so now we did start to rally off of that. But I was worried the whole time that it might not hold, and now it did take a news event that came out of nowhere to freak the market out. But it's always important to understand that it's not so much the news events that come out, it's the mood of the market. Let's see if I can explain this. you know, I try to make it relatable. Imagine if you end up winning the lottery, um, and you're now financially free, and you get home and you get news that maybe not a close family member, but a good friend of yours growing up had passed away. Well, obviously you'd be sad by the news of your friend passing away, but it wouldn't be devastating to you. Again, I'm not assuming this is a real close friend, but someone that you cared about. It wouldn't be as devastating to you because you're financially free now. You just won the lottery. Now, the opposite of that is, let's say you just lost your job and you don't know how you're going to survive. You know how you're afraid you're going to lose your house. You get home and you find out this friend of yours passed away. It's now even more devastating for you because of the mood that you're already in. You understand that? So the market acts that way as well. That's why when you see bad news comes out and the market keeps going higher, you're like, how is the market going higher? Well, if the market is already in a really bullish mood, then it shakes off that bad news. It's not like that bad news wasn't significant. It's just the market doesn't, well, I guess it isn't significant because the mood of the market, it shakes it off and goes forward. We were already in a worried condition in the market, with it already selling off the last few days. We're already worried, and the reasons for why we were worried was because of the bond market and the bond yields going higher, which were going higher because of the fear of inflation. So when this news comes out of nowhere, and it's inflation related, the market tends to overreact to it, or tends to react to it because it was already in that negative mood. So that's why you got to understand that principle, because otherwise you'll drive yourself crazy. You're saying, well, how come that news that's good or bad, whatever, didn't cause the market to go up or down? Well, if you're gauging the mood of the market properly, you can understand why it doesn't react the way you would expect it to certain news that comes out. But we'll see. We'll see if this is a little bit of a capitulation. I don't see a lot of support, though, in this area. We're breaking through support levels, so it has me thinking that maybe we have a little bit further to drop before we are going to bounce and maybe start rallying back up. All right, so we'll keep an eye on that. All right, let's get into some specific stocks here. And like I said, you definitely want to be waiting for some confirmation on some of these. Under retail here, under the hold section, this Big Five sporting goods, I've liked this one off and on as it's been an uptrend for a while. We've talked about this one before. It's a 96 strength rank. Let me switch this to signals here, but it's been in a nice uptrend. This has been kind of a part of the stay-at-home trade, as people have gone out and bought sporting equipment to keep in shape because the gyms have been closed and things like that. This could be a little bit of a ABC correction that's forming. Now, if this is a C leg, it could come down here a little bit further, so we'll keep an eye on that. But we're waiting for it to go back to the buy signal anyway. But this has been a nice little trend. Under the transportation sector, I think we went over this one recently as well, and I think I warned you about this. At the top of the list, 99 strength rank, it's YAYO. I think I like the pattern. The looks like a bullish ABC pattern off of a nice run up right here. Had a big up day yesterday. It's a little bit flat today, or down, pulled back a little bit today, but had really really strong up day yesterday. The warning I gave, though, is that this is over-the-counter exchange, so this is a really small company, and you might, there's going to be fewer people that if everyone runs in and trades something like this, you could artificially jack the price up on it. So you just might want to be a little bit careful with that one. But I did like the pattern on that one. Under industrial products here, there's this IPWR, Ideal Power Incorporated, 96 strength rank. But again, I'd like to see when you get these run-ups to see the pullback be a little bit more choppy as it pulls back. And it's at a point where it's retraced about 50% of this move up. So this is an area where if it's going to start going back up, this is where it should start going back up, is in this area. Now, it could still drop a little bit further if the market sells off, but actually this has been holding up pretty well with the sell-off. And you can see it was already trying to reverse. It was all the way up here. So here's where it opened. It was all the way up here. So it was already trying to reverse. That tells me there's buyers there. Then it sold off with the market. It's down here right now, but it's not down too far from where it closed yesterday. So that, again, this is where if you know how to read the price action, what it's telling me is that there's buyers there. Now they're probably pausing, or they're a little worried because they don't know what the overall market conditions are going to look like. But if the market turns bullish again, they might be jumping right back into the stock based on the way they're kind of behaving today. Now that could change. I mean, they're maybe they don't like the stock. They could change and not like the stock as much a day or two from now, especially if maybe people start selling because they have to, and it drops further than they'd like. But the price action today is telling me that there's some buyers there, and that they could probably come back if the market rebounds. Since we're waiting for it to go back to a buy signal anyway, we're going to wait for that confirmation anyway. All right. Under computer technology, it's 100 strength rank, but I do like this MVIS. And again, you can see why we've had the big run up here, and it looks like wave A, wave B, wave C. It's kind of got that. Now, remember how an ABC pattern works. You get that initial sell-off, which usually looks like a buying opportunity. You'll get a bounce, which is the wave B. Wave Bs are often called a sucker's rally. It kind of sucks people back in. And then wave C, you kind of wash out the buyers that weren't real committed anyway. And that's kind of what's happening right now. Is this looks like it's in that wave C. If this thing can go back to a buy signal, it could kind of resume that nice uptrend that's been in. Another one under computer technology, I think we talked about this on Tuesday as well. CPSH, 98 strength rank. Same thing, you can see that ABC pattern. Here's the initial sell-off. There's the suckers rally where this looked like the buying opportunity. It started to rally up a little bit, suck some people in, and then drop. By the way, when I talk about a suckers rally and it sucks people back in, and talk about crowd behavior, I talked about this when I was talking about the Elliott wave, that it's easy for us to sometimes think that we're not part of the crowd. We're not the sucker getting sucked into this. We're the smart people that avoid this. We all get caught up thinking it's a buying opportunity on a pullback sometimes, and I don't care how smart you are or how long you've been doing this. Because some stocks they do pull back in one move and then go higher. And if it pulls back in one move and you think you're in a strong uptrend, you think this stock is going to go right back up, and you're really convinced of it, it's easy to buy into that area and end up getting stopped out because it was just a sucker's rally. So that's kind of the tricky part but because you understand that, it allows you to manage your trade, though, because I might be convinced that was a nice, strong, bullish reversal day right there. I could be convinced this thing was going to just rebound and go higher off of that. And then if it rolls over, though, and maybe I'm starting to lose some money, I can have confidence to stop out of the trade because I know, okay, I got in on the suckers rally. We're probably in wave C. Wave C could drop us down a little bit further here. You can have a little more confidence stopping out of the trade. One of the reasons why a lot of people have trouble managing their trades, and particularly stopping out of trades, is they don't know why they need to stop out. They don't know why. They don't know how to read a chart, or they don't know how to understand, where is the area to get out. And so it's already tough enough to get out when you're losing money. I mean, nobody likes to lose money. You already are fighting that fear of losing money. And so if you don't know a reason why you need to get out, it's harder to do that. But if I got in on this first pullback, if I bought in on that and it starts to roll over, well, because I understand how ABC patterns work and how corrections work, it's easier for me to stop out knowing that thing has a little bit further to drop, because I understand kind of what's going on. And I still didn't avoid losing money, but I could have lost a lot more money. And sometimes the key to success is, can I get myself to be able to lose less money than I normally do? And we'd all like to just make money in the market, but one of the first steps, if you've been losing a lot of money in the market, is, can I learn enough to lose less? And then eventually, can I learn to make money, make sure I make more money than I lose? And you're trying to get over that threshold where you are now consistently making more money than you're losing. You're never going to get to a point where you're only making money. So if that's your thought process, let me change it right now, because it's never going to happen. You're always going to lose money in the market. But the key is getting that ratio to the point where you're making more money than you're losing. You're making more money when you're right than you're losing when you're wrong. Okay. Sorry, I didn't mean to spend so much time on that, but it was a chance to teach you something there. So, all right. And the last one, I'm going to drop down into the medical field. I haven't been in the medical sector for a while, but there is a stock that I've really liked, and it's pulled back, although I thought it was reversing today and would be a good buying opportunity soon, but it rolled over again. It's a 95 strength rank, this NK. Has a nice kind of distinct ABC, well, it looks like an ABC pattern, wave A, wave B, wave C. It's retraced get a little bit more than 50% of that move up, but it can be a little bit more. It's kind of at a critical area there, but you can see just an hour and a half ago, it was actually in a bullish reversal. Actually, it's been a couple hours here, but here's where it opened, and it was up here. So it looked like it had this wave C, and then it looked like you're getting a bullish reversal candle, which would have been for an aggressive entry, it would have been a good entry point, but it rolled over and it's down here now. So I'd be waiting for that to start moving back up, and we're waiting for it to go back to a buy signal anyway. So this is one you can keep an eye on. Now, if it dips down too much further, there is a support area from this previous high over here. You've got this previous high and you've got this little previous high. It's in that same area. By the way, when you're drawing these lines, don't expect exactness out of them. The market just doesn't move in exact ways. I like to call them support areas or resistance areas, or zones. I'll call them zones. Because as you can see, this high was a little bit higher than this one right here, which was an intraday high. This one actually closed down here. So if I say it's got to stop exactly at this spot right here, it could stop a little bit in front of it. It could actually dip a little bit below it, but it could find support in that area before going higher. And so you don't want to be so strict on your analysis that you expect exactness. But there's still some room this could drop and still end up rebounding and going higher. So, but this is an area where we would expect it to maybe stop that pullback and start moving back up again. So again, wait for it to go back to that buy signal. And if it dips below that support area, maybe forget it altogether. It might be in a downtrend now. It might be in a total trend reversal. And instead of this being A, B, C, and we're going higher, it could be that this is wave 1, wave 2. I'm talking Elliott wave stuff now. This could be wave 3. And then you get a little bit of bounce for wave 4, and then you get wave 5. And then you get, maybe that's wave A, and then you get a short-term rally up here for wave B, and then you have a bigger drop. So if it drops below this area right here, I'd probably move on to something else. There's other stocks that are in stronger trends for me to worry about, one that isn't acting very bullish at that point. That's another good lesson too. Don't fall in love with stocks. I don't care how many stocks have made you money. You have to learn to just, because sometimes we fall in love with them, we think they love us and they're always going to make us money. And I could tell you an example. This was Square. I mean, there was a time over the last 3 or 4 months, at any time Square pulled back, you bought it because it was going to go higher. It almost always went higher, almost went higher. And there's a tendency to think it's always going to go back higher again. And then when it doesn't, you think, oh, but this is Square, it's going to go back. And so you can end up losing a lot of money as it keeps dropping because you fell in love with that stock. It made you so much money before that you're thinking it's got to keep doing that. And if you're not careful, it could end up taking all the money it gave you during those uptrends. So be willing to move on to other stocks that are now outperforming. And that's part of why this process that we're teaching you here is important. That's why when I'm going to these sectors, I'm looking first at that 98 strength rank. Is there anything in that 98 strength rank that has a good pattern? And if it falls off the list, then let it fall off the list. I want to go to the next one that's performing right now, that's acting like it wants to go higher. All right, we'll leave it at that. I don't want to go over any more than that until we can see the market kind of quit freaking out. All right, let's get into the training for today. Now, we left off Tuesday. I was going to say yesterday, but Tuesday, we were just finished up talking about the option basics, what an option is. We talked about that real estate example of how an option kind of works. Let's kind of keep the definitions going by first focusing specifically on what a call option is. Now, a call option is very similar to that real estate example. So if you remember that real estate example and you just, instead of talking about the house, you talk about a stock, it's pretty much teaching you how a call option works. When you buy a call option, it gives you the right to buy. You are buying the right to buy, not the obligation, and that's key. You're not obligated to buy, but you're buying the right to buy a given asset, which in this case is a stock, is at a fixed price, which is the strike price. We'll talk about those here today as well, that definition. And in that real estate example, it was that $100,000 price that we were locking in with that option contract. So you have the right to buy a given asset at a fixed price anytime before a specific expiration date. In the case of a call option, the option writer, and anytime you see the word writer in the stock market, it means seller. So you'll either hear an option seller or you'll hear an option writer. And if you're familiar with covered calls, that's why we call it writing a covered call, is you're an option seller. By the way, after we learn about buying options, I will talk about being option sellers. Many of you that don't want to actually buy options because you might feel they're maybe a little bit too risky for you. You're going to use options. You're going to want to use options as a stock trader. And specifically as being an option seller, whether you're selling calls or you're selling puts. And we'll get to that. We'll have training on that as to why that's going to be a very valuable part of should be a very valuable part of your market strategy as a trader or an investor even. But the option writer or seller has the legal obligation to sell the asset, or in this case, the stock, to you at the strike price. And again, we'll go over that definition here in just a second. If you exercise the option before the expiration date. If you go to exercise that option and you bought the $70 call, so you bought the right to buy the stock at $70, and you go to exercise that option seller can't say, the stock could be up here at $75. They cannot say, oh no, I changed my mind. I don't want to sell you the stock at $70 because it's now worth $75. No, they've already locked in that price. They've already legally obligated themselves to sell you that stock at $70. Now, a couple key things in this definition here is first of all, you have the right, but not the obligation, and that you can exercise that option anytime before the expiration date. Now, remember what I said last week? On Tuesday, I said, when we're option buyers, we are buying the options to sell the options. we are not buying the options to exercise the options. I've been trading options for 20 years. I haven't, as an option buyer, I've never exercised an option because I explained that last week or last. I'll keep saying last week. I mean last Tuesday. I explained it a little bit more in that class, so I don't want to just keep repeating it. So, but I explained why. We're trying to take advantage of the leverage and not tying up all of that money or capital. All right, so, and call options are generally purchased when you expect the stock to go up in value. As a call buyer, you're wanting that stock to go up in value. That's why you're buying the call option. And again, if you keep it that simple, it's a lot easier to understand how they work and how you're making money on these. Now, put options are usually a little bit more difficult to understand, so I'm going to go over the definitions here, and then I will give you an example of how they work. A put option is just the opposite of a call option. When you buy a put option, it gives you the right to sell the stock, or in this case, a given asset, which is the stock, at the strike price anytime before the expiration date. You are buying the right to sell. The option writer, or the put option writer or seller, the person selling the option, has the legal obligation to buy the stock or the asset from you at the strike price if you exercise the option before it expires. Put options are generally purchased when you expect the stock to go down in value. This is going to be key, because if you want to know how you can make money when the market goes down in value, there's two main ways to do it. Two main ways. There's some multiple ways, but the two main ways are to short the stock or to buy a put option. Shorting the stock can be risky. Remember back during the whole GameStop thing, I did a training on how shorting works, shorting stocks, and kind of the risks associated with shorting. Or you could buy a put option. Buying put options is a much safer way to trade a stock down or to trade the market down. Now, how does a put option work? All right, let's say the stock is at $50. It's a $50 stock. And you buy the $55 put option. What does that mean? What have you bought? You bought the right to force the option seller to purchase or buy the stock from you at $55 if you chose to exercise that option. So you say, well, boy, this is great. You mean I could buy the $55 put option, and that means that I can force him to buy it from me at $55, and the stock is at $50 right now? Well, I'll just go buy the stock at $50 and then force him to buy it from me at $55. Could you do that? Well, yeah, you could, but guess how much that option is going to be to buy? That option would have to be worth at least $5 to buy anyway. So if I'm going to go buy that $55, and it actually would be a little bit more than that. When we get into option pricing, you'll understand how that option price, how it's priced. But for starters right now, that option would have to be worth at least $5. So if I'm spending $5 to buy the right to force the option seller to buy the stock to me at $55 and the stock is at $50, what good would it do me to buy the stock at $50 and force him to buy it to me at $55? Yeah, I'd make $5, but I spent $5 to buy that option, so I wouldn't come out ahead at all. Okay. But here it says to exercise the option, again, I could go out in the open marketplace and I could buy the stock at $50 and then force the option seller to buy it from me at $55. I would make $5 per share, or I could sell my put option for that same $5 profit. So what I'm expecting here is I'm expecting the stock to go down in value. Okay. The option seller is hoping that the stock goes up in value. What if the stock went up to $60. By the expiration date, here we are at the expiration date, that stock's at $60. Well, I'm not going to exercise my option. Why would I exercise my option and buy the stock at $60 because that's the market value of the stock, and then force the option seller to buy it from me at $55? Now, there's a common sense element to this, right? No one's ever going to do that. You're not going to buy a car at $5,000 and then go sell it to somebody else immediately for $4,500. You're never going to make money that way, right? So I'm not going to exercise that option. Well, what happened? Well, remember, I still spent $5 to buy it, which means that option seller gets to keep that $5. And I lost $5. I can't lose more than what I paid for that option, but I lost $5. So I don't want the stock to go up. I'm going to buy a put option when I expect the stock to go down. So let's say the stock went down to $40. Well, now, because I own the $55 put option, I own the right to force the option seller to buy the stock from me at $55. I could go buy the stock at $40 in the open marketplace and then force that option seller to buy it from me at $55. How much would I make? I'd make $15, right? I'd make the difference. Here's I can force him to buy it from me at $55, and I'd make that $15 profit. Or I could just sell the contract. I could sell that piece of paper that I bought for $5. I could sell it. It's now worth at least $15 because it dropped so far. It's worth at least $15. I could sell it for $15, and I've tripled my money. Now, why did I say we're always buying options to sell options? Well, you could do either one. I could just sell the contract and for $15 and triple my money, or I could exercise the option, buy the stock for $40 and force him to buy it from me at $55, and I'd make $15. The difference is, though, if I exercise that option, let's say I did one contract. Remember, one contract controls 100 shares of the stock. I'd have to spend $4,000 to buy that stock that I'm now selling for $5,500. Or if I bought one contract of that put option, it would cost me $500. Because remember, this price is per share. So, but you have to buy them in contracts. Each contract controls 100 shares. At least at this time, you can't buy partial contracts. I'm sure that's probably coming someday where they'll allow that. But right now, you have to buy them in contracts. But I'm only tying up $500 to buy that put, and yet I could sell it for $15 or $1,500. So I'm still percentage-wise, I'm making a much bigger percentage gain. Does that make sense? I'm only tying up $500 to make $1,500 instead of $4,000 to make $1,500 or to sell it for $1,500. See, the difference is still saying $1,500. But the percentage return is going to be much, much greater with the option. Now, the risk is, though, you have an expiration date. And that's going to be the tricky part as we get into option pricing, you're paying for additional time. So if I want to go out 6 months on an option contract, I'm going to be paying a lot more than if I go out 1 week. But I get to control the movement of that stock for 6 months as opposed to 1 week. And so to really be good at option trading, you got to be good at timing. You got to be good at timing when a stock is going to move. So you don't spend so much time, but money on the extra time you're having to pay for, but you get that leverage of that quick burst of a move that you're trying to take advantage of. Now, again, that's the explanation of how a put works, how you're making money with a put option. The bottom line, it can be a little bit confusing until you get it down. The bottom line is this is how you're making money when the stock goes down in value. If you just understand that if the stock goes down in value, your put option goes up in value. It's real simple and easier to understand until you can understand how. All right, a couple more definitions, and then we'll look at an example of this too. We'll pull up an option chain. You can look at an example. But strike price, this is the fixed price at which the option can be exercised. It's also known as the exercise price. Now, let's say the stock is at $73.20 or something like that. Well, when you look at option contracts and you look at strike prices, usually they're going to, well, it depends on the stock. It used to be that they would move in $5 increments for most stocks, but now a lot of them move in $1 increments. In other words, you can go out, there's probably going to be, it used to be that you would probably find a $75 strike, an $80 strike, an $85 strike. They used to move in $5 increments. Most of them would. What does that mean? Well, if I buy the $75 call, that means I'm buying the right to buy the stock. I'm buying the right to buy the stock at $75. I buy the $80 strike. I'm buying the right call. That is, I'm buying the right to buy the stock at $80. And nowadays, like I said, they move in, you probably have a $78 strike, a $79 strike, and they tend to move in $1 increments. Some of the smaller stocks, they're like $10 stocks or something like that, they might move in 50-cent increments where there's like a $9 strike, an $8.50 strike. So basically you have to use whatever that particular stock, whatever the strike prices are of that stock, you have to go with whatever those strike prices are available. You can't I don't care how much you want to, if there's a $70 strike and a $75 strike, I don't care how much you want a $72 strike. If it's not being offered, you can't get a $72 strike. You have to go with whatever the marketplace is giving you for those strike prices. But most time they're going to be, nowadays, most of the larger companies are going to be in $1 increments or sometimes 50-cent increments, depending on if they're a smaller price stock. Expiration dates. This is the date on which the option expires. Now, it used to be that that options were monthly, meaning that they would always expire per month. I could get a March expiration option or a April expiration option or a May expiration option. And there still are some of the smaller companies, they start off with just regular monthly options. And if that's the case, they are going to expire on the third Friday of the month. So if there's a regular March option right now, doesn't have weekly options available to it, it would expire on the 19th of March, which is the third Friday of March. Now, tricky thing is here, you need to understand it, but it doesn't really affect you. But technically, the options expire on the Saturday following the third Friday of the month. But because you can't buy or sell options after the market closes on Friday, then for us, for our purposes, that option is expired when the market closes on Friday. So the third Friday of the month would be when that option expires. But officially, the clearing and all that of it happens on the Saturday following the third Friday of the month. And that may have changed. I don't know, with the speed in which things are confirmed now, and the clearing process. It may be that it's quicker than that, or sooner than that, or what have you. But the bottom line is, it doesn't affect me. So even if it is quicker, it doesn't matter to me if it's changed in time. But that's officially when they expire. Now, like I said, just over the last 3 or 4 or 5 years, a lot of stocks have come up with weekly expiration options. In fact, if you're trading the SPY, which is the S&P 500, there's now even intra-week options. You have a Tuesday expiration or a Wednesday expiration, but it's usually only on. You're not going to see that on individual stock. You will someday. There are going to be daily expiration options on almost everything, because the option market is just growing and growing and growing, and it'll be available at some point. But right now there are weekly options available. So if I wanted to buy if I thought that stock was going to move up tomorrow or by tomorrow, tomorrow might be cutting a little bit close. I forgot we're on Thursday right here, but let's say I think it's going to move up next week. I can buy an option that expires. On most stocks, most of the larger stocks, I could buy an option that expires next Friday, which would be the 12th. It would be it'd expire for the week there. Now, usually there's only weekly options available, though, for the current month. As you go out further, like if I wanted to go out till April, you're not going to be able to find, in most stocks, you're not going to be able to find an first week of April expiration. Now, you will, because that's another thing to realize, is that expiration dates can be added when you finally get to April or get close to April. The market maker out there will provide options available each of the Fridays in April for those larger companies. So, but that's where most of the option activity is, within the current month or within the few weeks. Let me go over bid-ask spread, and then we'll look at the example. Look at an option chain example here. And you should already know this if you bought or sold stocks before, because it's the same with stocks. You buy at the ask price, you sell at the bid price. The bid-ask spread is a difference at which we can buy the stock or the option and what we can sell it for. If the ask price, and this is maybe a little bit of an extreme example here, but if the ask price is $5, that means if I want to buy that option, I'm going to have to buy it for $5. If I wanted to turn around and sell it, I'd have to sell it at the bid price, which might be at $4.50. So there's a difference there. Now, the difference there is what the market maker gets for his services, for making the market, for allowing you the liquidity to be able to buy and sell. When you want to buy, you get to buy, and when you want to sell, you can sell. That liquidity is provided by the floor. It used to be the floor trader, but now it's computers. But the broker, or the market maker, is usually your broker. He's the one you're usually buying from and selling to. And you don't have to worry about that right now, how that whole process works. Just understand that that's how they're getting paid, is they're getting paid that spread, that difference. For all the people that want to buy the option, they're selling it to them for $5. For all the people that want to sell their options, they're buying them from them at $4.50. It's no different from a car dealership or something. They're buying their cars for $20,000, and they're trying to sell them to you for $25,000 or $30,000, whatever. I don't know how the automobile industry works, but they're trying to sell it to you at a higher price so they can make a profit, right? They're going to make that difference between what they bought and sold. That's all that's going on here. Okay. But it's something you have to realize, because you realize that when you enter into a trade, you're already entering in at a deficit. If you change your mind and want to get out of that trade, you made a mistake, or like today, you bought a call option and then the market starts falling apart. You want to get out. Well, you're able to get out, but you got to get out of the bid price, and so you're underwater a little bit. I need that option to go up in value to where the ask price is $7, but the bid price also went up. It's $6.50. So I bought the option at $5. I can sell it. There's a sell price right here. The bid price is $6.50, and that's what I could sell it for. Okay, and that's how I'm profiting. I made money there, but I have to overcome that deficit before I start making money. And usually it's not 50 cents, but it's easier to teach the concept with a nice round number there. All right, so let's look at an option chain. Here's one I just pulled up. Now, to find an option chain, you might have to get that help from your broker. I don't have every broker out there. I don't know how every platform works and what it looks like. So if you're using a platform I've never used before, I don't know where their option chain button would be, but it's usually right where when you pull up a ticker symbol for the stock. If I typed in Apple, somewhere around where it pulled up the information on Apple, it should show you a button that says option chain, or it might just say chain, view chain, and that's what it means. It's the option chain. But if I pulled this one up on Apple or typed Apple into here, it's showing me the stock at the time as of right now. I'm believing it's right now. Let me refresh the page here just in case. Give me a second here. Yeah, hold on a second. I've been talking for so long it logged me out, so I got to log back in here real quick. Okay, hold on. Okay. All right, so I logged back in, so I'm good here. Now we can look at this. So this is an Apple, and the current stock price of Apple is, where's it showing? It's not showing it here right now. Oh yeah, it's right here. The current stock price of Apple, the ask price of Apple. If I want to buy Apple right now, the ask price is $120.10. That's if I want to buy the stock. Okay, so if I want to buy 100 shares, I'm not going to use it. I'm going to round this here. If I want to buy 100 shares of Apple right now, if I want to buy 100 shares of Apple right now, it's going to cost me a little over roughly $12,000, right? Okay, that's if I bought the stock. Okay, what if I wanted to buy the right to buy the stock at $120? Okay, well, here's your strike prices right here for the calls. I want to buy puts, strike prices over here. But let's do calls first. Hold on just a second here. Now keep in mind, what I'm trying to show you right now is I'm trying to show you just how how options are. I'm just focusing on the definitions. We're going to have a class on option pricing to understand the option prices. How do we come up with these different prices? Okay. Hold on, I erased my thing here. So stock is about $120 right now. If I bought 100 shares of stock, it'd be 12,000. So all I'm trying to do is help you just kind of understand the general concept. As far as deciding what strike price to choose or what expiration date to choose, we'll get into that later, because you can't get into that now if you don't understand what a strike price is or what an expiration month is. So let's get the definitions down. And like I said, this class, I'm teaching this class from the standpoint of someone being complete novice, complete beginner at trading options. And then we'll progress to get more and more into how we can trade options, be a little bit better at trading options as far as selecting strike price, expiration date, and things like that. I'd tie up $12,000 if I wanted to buy 100 shares of Apple right now, right? 100 shares. Or I could go, let's say I think that Apple is going to go up, for the rest of the month. Okay. I could go out here, and here's the April 1st. This expires on April 1st. And I think that's because, that's a Thursday, but I think if Good Friday, I think, is the 2nd of April this year, if I'm not mistaken. I could be mistaken on that. If the market's closed on Good Friday, so that could be why that's showing that as April 1st. But and that's another thing to keep in mind, that if the market is closed on a Friday, then the options expire the Thursday, the day before, when the market closes on that Thursday. Okay. All right. So let's say I wanted to participate in Apple going up in value for the next couple weeks until April 1st. I could go buy the 120 call. Here's the strike price call. You can see these are moving in $1 increments. I can buy the right to buy the stock at 120. I can buy the right to buy the stock at 121. If I buy the right to buy the stock at $120, it would cost me $5.25. However, remember, this is a per share quote. And to buy one contract, which is the minimum I can buy, it controls 100 shares. So that one contract would cost me $525. For one contract. Oops, I'm going to just abbreviate con. I was going to just put C, but then you might think that means call. So one contract. So I get to control the movement of Apple going. If it goes up in value, I get to control that movement for only $525 instead of $12,000 until April 1st, until that expiration date. Now, let's say that Apple goes from $120 up to $135 by April 1st. Well, I could sell the stock. If I bought the stock, I could sell the 100 shares for $135, and I'd sell them for $13,500. Or a $1,500 profit. Or I could just sell my option. Now, what would that option be? Now, I'm probably getting a little ahead of myself, because this will make more sense next week when we do the option pricing. We'll learn about how did we come up with $5.25. What makes up that price right there? Well, I do know what the minimum of that price of that option would be if the stock went up to $135, because I can't make more than it can't be lower than the exercise price. So if I own the right to buy the stock at 120 by buying that call, that option would be worth at least $15, because that would be the exercise price. So my choices at that time, I could go and I could exercise my option. I could buy it for $120 because I have that right to buy it at $120. That 100 shares, it would cost me $12,000 to buy it. And then I could turn around and sell it at that current market price. If it did go up to 135, I could sell it for 135 and I'd make that $1,500 profit. Or I could just sell my option. In this case, I'm just going to make the math simpler here. Let's say that call option is worth $15.25. I spent $525 to buy it. I could sell it for $1,525. 1,250, excuse me. It's the same amount, basically. It's basically the same amount as I could by selling the stock, but the leverage, I only had to tie up $500 instead of $12,000. Now let me refresh the page. We can see right here the ask price is currently $5.25. Let's see if the stock has moved enough here. It's now the ask price is $5.30. So it's gone up a little bit, but it hasn't gone, the bid price hasn't gone up enough. So right now, in just the time I was talking, I could have bought that option for $5 and, or what was it? Was it? I just forget. Was it $5.15? No, it's $5.25, right? That's what it was. So it hasn't moved up enough. This hasn't gone up enough. I'd still lose 5 cents if I sold it right now. But that bid price or that ask price moved up a little bit, which means we need it to move. We need it to move a little bit. But that at least gives you, we're going to get into this in more detail. It'll make a lot more sense when we get into what makes up these prices right here. But just to show you real quick though, let's say I wanted to go out further than April. What if I want to go up to near the end of April right here? April 23rd expiration. Well, that same $120 call is going to cost me $7. It's going to be more. What if I want to go out till tomorrow? Well, that 120 call would cost me $1.56 if I want to buy it. Okay. All right. That's a good stopping point for now. And next week we'll start getting into intrinsic value and extrinsic value and implied volatility and all this other stuff that you kind of need to be aware of, be a good to understand trading options. But in the meantime, if you want to, first of all, a homework assignment this week is to go and find the option chain on your broker site, and if you need to call them or text them or whatever to help you find it, that's who you need to go to. I won't be able to help you with that. And then just act like you're buying an option. Again, do it on paper. Don't go buy it, but just so you're learning a little bit how it works. Go out till you could even, because we're not worried about selecting the right expiration month or strike price right now. Just go and go out to next week. Go to March 12th on Apple and buy the strike price that's closest to the stock price right now. Go buy the 120 call on paper for $3.20, and then follow it throughout the week. If Apple goes up, you'll see that call option go up in value, and you'll see how much it goes up in value. But make sure you're looking at the bid price at that point, because that would be what you'd be able to sell it for. If Apple goes down, that's fine too, because we're learning right here. You'd see how that option goes down in value, because guess what? That's going to happen. We're going to buy an option at $3.20 that could go to zero. But key point here, if I buy this option for $3.20 or $320 for that one contract, I can't lose more than $320. Okay. So I'm limiting my risk. But see, that's why I say that trading options is not as risky as people say, because what if I buy the stock at $120? Let's say that stock drops down to $100. I could lose $20, right? But guess what? If it keeps dropping, I can lose more. If it goes down to $90, I can lose even more money. So this limits your risk. Okay? But then just watch it. Watch it as it goes up and down, and you can kind of see how it's moving. And that'll also prepare you when we get into what makes up that price. You'll understand that a little bit better next week. Okay. All right. Thanks, everyone. Have a great week. We'll see you Tuesday for the next market update. Bye now.